Yes, you are welcome to class again. And tonight it's a revision on investment appraisal. And investment is what everybody know. Yes, it's putting your money into a venture for you to get a better return in future. So talking about investment or investment appraisal results into decision. Investment appraisal will result into an investor to make a decision. Now, when you appraise investment, arrays of investment, you are trying to make a decision which is more profitable, which will give you the best return in future. In which of these investments can you recoup your money? So investment appraisal will lead to decision making. So capital investment, when we talk about investment appraisal, we're talking about capital investment. Capital investment is also known as capital expenditure or capital budgeting, and it involves the process by which an organization commits its funds into long-term projects that is project that span over one accounting period, such as construction of bridges, roads, dams, refineries, power plants, land, buildings, and so on and so forth. So these are long-term investments. So ordinarily, companies should pursue investment opportunities that will increase the value of the business. Yes, and which will invariably maximize the shareholders' wealth. So, but most times, because of limited resources, there will be need for rationing. So, because finance is limited, and most times they are not available at a given time for an organization to invest in a project. So management of an organization will need to use what is called capital budgeting techniques. Capital budgeting techniques such as net present value, adjusted present value, internal rate of return, and so on. And they use all these parameters to determine the viability of a project that will help a company or an organization to achieve its target objectives among arrays of projects, among competing projects or investments. So the need for capital investment is for organization to tie their fund into long-term projects that will result or yield better return in future. So there are various two techniques of investment appraisal. We have the discounted techniques and the non-discounted techniques. We talk about the investment appraisal. On these, the the non-discounted techniques is otherwise referred to as traditional or conventional method. And under this, you have issues such as payback period, accounting rate of return. An accounting rate of return can otherwise be referred to as what? Return on capital employed. Return on capital employed. Now, when we talk about the payback period, what do we refer to? This is revision class. I'll be very much calm so that to give room for you to hear your voice and let me know that you are doing well. When we talk about payback period, what do we refer to? What are we referring to?
Good evening, sir.
Good evening, sir.
Yeah, payback period is the length of time it's required to recover the entire money invested on the project.
Yes, thank you, sir. So when we talk about payback period, this is a period that is usually expressed in years, which takes cash inflows to equate cash outflow in capital investment. So in most times, payback period is often used as the first screening process in order to determine the years it will take a project to recoup the initial investment. So when we talk about these non-discounted cash flow, looking at payback period and accounting rate of return, in our usual class, we make a simple equation. Yes, we show a simple equation. Now, for me to get my cash flow, please take note of this equation. For me to get my cash flow, if I'm giving accounting profit, what will I do? Yes. For example, in a question, you have your profits, you have your net profit, you have your net loss, and you are expected to determine cash flow. What will you do? What will you do? Anybody to help? What will you do? You are not giving cash flow directly. And you know, when you're talking about investment appraisal, you are looking at cash flows and not profit. So when you are giving profit and you want to determine your cash flow, what will you do? Because when you are asked to solve for NPV, you will discover you are comparing cash inflow and outflow. Yes, anything that is not cash flow will not be component of your NPV. Yes, will not be part of the preparation of your NPV. So when you are giving, let's say, net profit, and you are asked to prepare NPV, you know you need to convert that profit to cash flow. So what is the technique behind that? We discussed this while we were treating investment appraisal. If you have your notes, you see it. So you are giving profits and you are expected to determine the NPV. What will you do? Can anybody help me out in this regard? This is revision now. Yes, this is revision. Just speak it
If
out.
you are, let me try, sir.
All right,
If you
try.
are giving cash flow and want to determine our NPV, think we have to get is it that we get the um accounting profit
No,
to
this is the question, man. This
all
is the
right,
question.
sir.
You are giving profits
Okay,
and you are asked to determine NPV.
NPV. Then
Yes,
we need to add back our depreciation to the profit we are giving.
very good. That is just the mathematics. That is the mathematics. The examiner can twist it. They will just give you profit. The way you are seeing in this question here now, this question that is looking at you, that is the technique there. I know some of you might have this say, let me attempt this question on my own. And as you are attempting, so when a question is asking you to determine NPV, internal rate of return, and the rest of it, what you need to do, the equation is you have to study the question very well. Please, as you prepare for this exam, allow the question to lead you. Yes, don't think you know a topic and just go and dabble into a question like that. Allow the question to lead you. Yes, don't go ahead of the question. Don't just read the question and say, this is NPV, I know it. Every sentence, every word in the question, take note of it. Take note of it and go by the leading of the question. This is very important as far as this exam is concerned. Yes, you might know a topic very well, but because of the joy that I know this, you failed to read line by line what the requirement of the question is. What are the elements in that question? Because the examiner will not just give you something free of charge. They'll want you to think from behind. and come up with something. So as you read question, settle down, read, and allow the question to guide you. Yes, allow the question to guide you. So when you are giving accounting profits and you are asked to prepare things like MPV, the equation is this. It is, let me write now. The equation is this. The equation is this. You have it as cash flow. Cash flow is equal to accounting profits. Accounting profits or loss plus what? Plus depreciation. Plus depreciation. Now, where a question is giving you accounting profit or loss, where a question is giving you accounting profit or loss, what will happen? How will you determine your cash flow?
Minus depreciation.
Fine. You minus depreciation. So it will be what? It will be what? It will be, what will be the expression now? When a question is giving you accounting profit, what will you do?
Cash flow minus depreciation.
Depreciation.
Okay, cash flow minus depreciation. So, and when you do that, you will get what?
Profit after depreciation.
Profit after depreciation. Okay, oh, you get profit after.
But you just told us that we're to add depreciation
Yes,
to profit.
very well.
Then if it is situation of loss, are we to deduct depreciation, sir?
If it is situation of loss, it will be minus
Yes, sir.
negative. Minus negative. Yeah, it will be
Okay.
negative. You know, loss is negative plus depreciation.
Yes, sir. Yes, sir.
Yes. So now,
All
when
right,
you are
sir.
giving
Thank you, sir.
accounting profit in a question, what will happen? You will need to determine what? Your
You add back
depreciation
depreciation.
to get your what? Your cash flow. You add back depreciation to get your cash flow. So when accounting profit is given, it should be converted to cash flow before calculating your MPV, before calculating your payback period, and so on and so forth. So the point is this: based on this understanding now, let's just branch to this point. Let's branch to this question. Let's branch here for the meantime. That Lam Lam Limited is currently considering two mutually exclusive investment projects. Both projects are concerned with the purchase of new plant. The company made available the following data for each project. For each project, we have project A and B. Cost, that is immediate outlay, 200,000 for A, for B, 120,000. Expected annual net profit or loss. Year one, the profits is 58,000 for A and 36,000 for B. Year two, we experience a loss on both projects, a loss of 2,000 for A and a loss of 4,000 for B. Year three, we have profits of 4,000 for A and the profit of 8,000 for B. Expected residual value. Another word for depreciation is what? Or for scrap value is what?
Residual value.
Yes, is residual value. That is another word for it, is residual value. So that's Lam Lam Limited. Lam Lam Limited has an estimated cost of capital to the tune of what? 10%. 10%. And what? And employs the straight line method of depreciation. Employs the straight line method of depreciation for all fixed assets when calculating net profit. So neither project would increase the working capital of the company. The company has sufficient funds to meet all capital expenditure requirements. All capital expenditure requirements. So the point is this. If you want to know what is the value of the investment as at the beginning, the value of the investment as at the beginning, this question will make you to revise many things. Yes, it will make you to revise many things. So the point is this. If you want to know the value of your investment, what is the formula? If you recall, if you've been studying your book, there is something you must know. The value of your investment. Or let's say you want to calculate depreciation. Let's say you want to calculate depreciation now, based on this question. How are you going to go about it? Yes, somebody should guide me. You want to calculate depreciation.
Cost minus residual value of useful life.
Okay, fine. So the depreciation for A will be what? For project A will be what? The depreciation for project A will be what?
It's going to be 200 minus 14.
Over 3. All
Divide
over
by
3
3.
years.
All the way. So the depreciation is on straight line basis, same value for the 3 years. The result will be what?
$662,000.
662,000.
62,000.
62,000.
62,000. Fine. So let's now move back. For year one, what will be your cash flow? For year one, what will be your cash flow?
For year one, our cash flow will be the annual profits. We'll now add depreciation.
Yes.
To get our annual cash flow.
And what will that be now?
So for year one now, it will be 58,000 plus 62,000. Sir.
So we have what? 120,000.
That will now be our annual cash flow for year one.
For year one. Let me pause here. Who is not getting what we are doing? I will show the workings, but I want us to look at it first in that way. Who is not getting what we are doing? I want to know. I know some of us joined late, and I know I might get questions from such persons. But at this point, before we go far, who is not getting what we are doing? Okay. All right. Fine. I've seen your hand now. So, all right. So what we're doing is we're trying to do a cross-fertilization of knowledge, trying to run around all what we've learned on investment appraisal by trying to see the issue of discounted cash flow and non-discounted cash flow. The non-discounted cash flows We have things such as the payback period, the accounting rate of return. One thing with all this is that they don't look at profits, they look at cash flows. They look at cash flows. And for you to get your cash flow, where you are not giving your cash flow directly, and you are giving
Granite.
profits, and you are giving just profit, the approach is you must get your depreciation. Once you get your depreciation, you add your depreciation to what? To your profit to get your cash flow. To get your cash flow. That examiners can be tricky by just giving you the value of profits. And when you are not very careful, you will use those values as your cash flow. And that is wrong. So for you to get your cash flow, you must determine your depreciation, add back depreciation to your profit to get cash flow. To get cash flow. So we are now looking at this question. This question, if you look at it closely, you are giving profits or loss for project A and B. We have 3 years lifespan for the project, and for you to get your cash flow, as far as this question is concerned, is for you to know what your depreciation is. The question made it clear that this company employs straight line method of depreciation, which means that the depreciation value will be constant all through the 3 years. So for you to get your depreciation, it will be what? Your initial outlay, that is your immediate outlay, which is 200,000 minus what? Your residual value, which is otherwise known as what? Scrap value. Divide by what? The useful life. The useful life is what? Is 3. So we now said 200,000 less the scrap value of 14,000 divided by 3. You're going to have depreciation value to be what? To be 62,000 naira. So when you add 62,000 to your year 1 profit, you get cash flow. You get cash flow for year 1. So for you to solve net present value, you don't use profits. Net present value, the discounted cash flows, non-discounted cash flow, what they recognize is what? They recognize cash flow and not profits. They recognize cash flows and not profits. So you must work back to get your cash flow. So let me show that. I will show that.
Hello, sir.
Yes,
Hello,
I'm with
Mr.
you.
Tokwe.
I'm with you, sir.
In finance, before we get to our net profit, we
Yes.
first determine our earning before depreciation and tax. And for this one, meaning that they have not take depreciation into consideration before arrive at this net profit. So, for my own thought, I thought we suppose, since they have not incorporate depreciation in the net profit, I thought we supposed to less it. Why are they need back?
Based on your basic accounting knowledge, for you to get your net profit, how do you get it? When you look at the format, do you less depreciation or you don't less depreciation to get net profit? You less. So yeah, you need to add.
Depreciation.
Yes, you less depreciation. So that's why we are adding it back now. Yes, to get our cash flow. We are not working with net profit. So they've already deducted depreciation. Yes, from this. So, and that is why we are adding it back to get the cash flow. To get the cash flow. So, sir, this net profit, the elements of depreciation have been deducted from this. And that is why we are adding it back to get cash flow. I don't know if that is fine, sir.
That's fine. Thank you, sir.
So this is revision class. I'll be asking questions. Yes, because what you say will stick to you and you remember in the hall. You remember in the hall. Yes. So don't say what is in your mind. Yes. If you are right, we'll say fine. If you are not right, we'll correct ourselves. Correct
Hello,
ourselves.
excuse me, sir. Good evening, sir.
Good evening, sir.
Okay, I normally see this straight line method. Can there be a time when they will set a question and tell us to use a reducing balance method for the depreciation? Is it possible?
Very well, sir. I don't know if you check the. Did you check the assignments? These other questions. Let me see. The other question we forwarded that you say you are going to attempt, sir.
Okay, yeah. It's true. Yeah, the last one we did. Yeah,
That you say you are going to attempt. Why didn't see your attempt, sir?
I forwarded it. Is in the platform there.
Okay. Okay. Let me see. Okay, can you see this, sir? Tax allowable depreciation will be claimed at an annual rate of 25%, reducing balancing in year 1 to 3 and the rest of it. You understand? So this is a
Yeah,
concept of reducing balance to not always be maybe straight line. So it depends, but you must just know the application. You must
okay,
know
sir.
the application, sir.
Okay, sir. Thank you.
So let me ask, what is net present value? It's not all about knowing how to solve it. You must know what it entails, what it refers to. Yes, there should be a practical understanding, not just cramming. Yes. What is net present value? Net present value. Yes, net present. You must be able to interpret this beyond just knowing that for me to get net present value, I will use one discount factor and the rest of it. So what is net present value? If you solve that question, the question I forwarded last weekend, you should be able to tell me what net present value is. Yes. So what is net present value, class? You know, this is revision. Those days in secondary school, our teachers will just come to class, all what we learned, they'll start asking us, revision week. So it's revision now. So net present value. Yeah, somebody should speak. Don't look at your phone. Just tell us something. What have you pictured about net present value? Yes, or you just solving and cramming the pattern.
Good evening, sir.
Thank you, sir.
Net present value simply differentiates between the present value of cash inflow and the present value of cash outflow on a particular project.
Yes, and that is it. If you are solving to determine present value, let's say you are giving a comprehensive question. A comprehensive question. If you read that question very well, you will see elements of inflow, you will see elements of outflow. So the difference between the present value of cash inflow and the present value of cash outflow is NPV. Is NPV in capital investment. So NPV is one of the discounting cash flow techniques that takes into consideration the time value of money. Time value of money. That is why we discount year 1, year 2, year 3. What is the discounting factor? What is the cost of capital given? And that is why you use your formula 1 plus r to the power of minus n, or 1 over 1 plus r. Yes. So you discount. You discount by recognizing the time value of money, because 1 naira today is not 1 naira tomorrow. What 1 naira can buy now, it will not buy it tomorrow. And you need to factor in the time value of money, because money in the present world is more than the same amount in the future, is worth more than same amount in the future. So NPV is used in capital budgeting to ascertain the financial viability of a project or investment. So the point is this: a viable project will increase the value of a company. and that will invariably maximize the shareholders' wealth. So question can come and ask you, why do you think NPV is important? Or why do you think NPV is the best? That is leading you to the advantages of what? NPV. What do you think are the advantages of using NPV over other form of discounted cash flow techniques or non-discounted cash flow techniques? So what are those advantages associated with using NPV?
Hello, sir.
And with you, sir.
NPV give a clear either to accept or to reject a project.
All right, sir. Thank you, sir. Yes.
It also consider time value of money.
Yes, consider time value of money. Oh, these people are not in the kitchen.
Some of us are at work, oh, especially me.
Hello, sir. Hi, network.
I can hear you, sir.
Okay, can I say that MPV is used for to make comparison? Can't even hear myself again.
Sorry, I've been rejecting a call since, but I discovered the person was persistent, so I have to pick the call. Yes. So talking about the advantages of NPV, yes, as Mr. Emmanuel have put forth that it takes into consideration the time value of money. Yes, please know all this. The examiner can test you on some of these little things. Yes, and it will not be it will not be good if I can't write on some of these little things. Yes, please take note of them. They might look so as if they are simple. Then the first time they are testing us on financial management, we don't need to take chances. Every little thing you can read, just read them and be very good at them so that you'll be able to answer well. So MPV takes into consideration the time value of money, and more so, it is based on cash flows and not accounting profit. And one thing with MPV is that it considers the whole life of the project. Yes, the whole life of the project. Unlike the payback period, if you still recall your payback period, the payback period does not consider the whole life of the project. It is at that point whereby you can recoup your money. That is when you stop your evaluation. Yes. But with MPV, it considers the whole life of the project, and in absolute time, I would say it measures in absolute terms. That is the shareholders' wealth. The shareholders' wealth. For example, let's assume you have an investment in Naira. It will give a clear measure of your wealth, of your investment, without any form of complexity. Without any form of complexity. But one thing with this MPV, to a layman, is it very easy to comprehend? Is it very easy to comprehend?
It's difficult to understand to a layman.
Yes, so that is one of the demerits now. One of the cons, it's disadvantage that it is difficult to explain to managers because most managers are not familiar with cost of capital. Another word for cost of capital is hurdle rate. Please take note. Hurdle rate. Yes. Hurdle rate. Hurdle rate. That is another word for it. The examiner can use that word and you begin to ask yourself, what is this again? Take notes of that, please. And the issue of MPV, it's built on the concept of cost of capital. It works in relation to cost of capital concept. And even as a student, sometimes this concept is difficult to understand. Talk less of trying to explain to a layman. So if the manager is not financially inclined, you, the financial experts, we need to talk and talk and talk for the manager to understand. So in simple terms, it is complex to calculate. It is complex to calculate. Now, let me ask in a very quick way, though I've mentioned it, what is the formula to calculate your discounting factor? Somebody should just say it very fast. To calculate your discounting factor.
Do 1 divided by 1 plus R.
1 plus R power minus N.
Yes. So either you do it in two ways. It can be 1 plus R to the power of what? Minus N. You know, in indices, when you put 1 on that minus will run away. So it can be 1 over 1 plus R to the power of just N. So when you put 1 as the numerator, the minus N will be eliminated. But when you don't put 1 as the numerator, it will be 1 plus R to the power of what? Minus N. Minus N. And what is that R? R is the cost of capital given to you in the question. And the N is the useful life. If you are calculating for 1 year, if you're calculating for 1 year, N will be 1. For 2 years, N will be what? 2. And the rest of it. So going back to that question. Okay, before then, how do you calculate annuity factor? Annuity. What is the formula for annuity?
1 minus 1 plus R raised to power minus N over R.
I didn't get you now. Well, I don't care.
1 minus 1 plus R raised to
1
power minus
plus,
N.
okay.
1 plus.
Okay. 1 plus power minus R.
I did open it before now. So.
Madam Lucy, are you trying to speak to us?
Yeah, sorry. I think I've answered this one. Sorry.
Let me hear from you.
You're asking for the formula for me, right?
Yes.
Okay. The formula is 1 over 1 plus R raised to the power of N. At the minus N rather.
Okay.
No.
That is not
There
it. So
is
that is why.
one.
Right now,
One open bracket minus I raised to n over R.
One minus.
no, this is why it is revision. I want to know what you know.
Mr. Tobe,
Sir,
somebody's laughing here.
Because
the thing is,
everybody,
I realize
yes,
one
madam.
minus
Mm-hmm.
1 minus bracket 1 plus I bracket minus n over I.
Okay, fine. You can put it that way. But it is
It can also be R. Yeah, I used to put R.
yes, anyone, whichever is fine. So annuity factor can be computed as 1 minus open bracket 1 plus R to the power of minus n divided by what? R. Divided by R. And your R is what? Your cost of capital or discount rate. And N is what? Your useful life. Your useful life. So there are certain things, there is this keynote I want us to note when we are solving question. Though we'll come to that question. We'll go back to that question very soon. But beyond just attacking questions, there are basic knowledge that we need to have. Yes, because the question, you also see written parts in the question. It's not about solving and solving. You see some written aspects in the question. So the point is this: there are 3 determinants for calculating NPV. There are 3 determinants for calculating NPV. And those determinants, number 1, we have the relevant cash flows. You must be able to know the useful life, the number of years of the project. The number of years of the project. So in simple terms, NPV is present value of cash inflows minus present value of cash outflow. So because we don't have time, I will not present simple question. I will just quickly go to this question. I'll come to this question. I think this question we hover around all what we're trying to say. So looking at this question, I believe everybody is having this question. So we are asked to calculate our present value. That is the number 1 thing. And for us to calculate our present value, we need cash flow. We need cash flow. Now, what you are seeing on the screen, this 58,000 is what? Let me ask again, even though we explained it. This 58,000 is what? Is this cash flow?
It's a profit.
The profit.
Okay. Just profit.
Profit.
One net profit for year 1.
Fine.
Inflow.
Okay. Somebody's saying cash inflow, right? We've explained that. Okay,
No,
Matt.
I thought you said that it will be cash flow when we add back the depreciation.
Yes. So I'm just trying to tell her that it is not cash inflow, Madam Faith. This is, see,
Okay, sir, please, can you share the question? I don't have it.
Check the group chat now.
It's on the group, Faith.
So this is not, I'm just trying to, I know some people join late, so I'm just trying to come back again somehow. I'm not supposed to be asking what is this again. But you just need to know some things. So this is expected annual net profit or loss. This is not cash flow. So when you add back your depreciation, it becomes what? Cash flow. So because of time, let's quickly go to see how we can solve this question. But you will lead me to solve this question. Though I forwarded the question, but you show me the answer. You lead me through this process. So though I've explained that first, you need to calculate your depreciation. We'll talk about project A. I'll quickly deal with project A, then you deal with project B. Yes, let me deal with project A for now. Project A. Project A, our initial investment is what? Our cost immediate outlay is 200,000. Our scrap value is what? Residual value is what? 14,000. And the number of years is what? Is 3. So the first step, since we've known that this is not a cash flow, for you to return them back to cash flow, you need to get what? Your depreciation and add depreciation back to it. So your depreciation will be what? For project A. For project A, calculate. Let me just show the steps. Calculate or calculation. Calculation of depreciation. Calculation of depreciation. And depreciation, how do you compute depreciation? Using straight line method. Depreciation is equal to what?
Cost minus residual value of a useful life.
Yes. So we have it as it can be from the question, it can be initial outlay, initial
Minus
outlay
residual
minus what? Scrap value.
value over useful
Scrap value scrap value divided by what? Useful life. Useful life. So based on this, your depreciation will be what?
60,
62,000.
62.
So the initial outlay for project A is what?
200,000.
93,000. That's 93.
Okay, if you know your background is noisy, you can just follow us so that you don't need to. And the useful life is 3. So once you simplify, your result will be what?
93,000.
The result should be 62,000.
52,000.
So the next will be calculation. Will be calculation of cash flow. Calculation of cash flow. For you to calculate cash flow will be equal to what? Profits or loss plus what? Plus depreciation. Profit or loss plus depreciation. Cash flow. So we have our years. We have our profit or loss. I'm picking this table now. I'm working on A using this table. We have our years. We have year 1, year 2, year 3. And we have our profit or loss. Profit or loss. For year 1, our profit is what? 58, right?
58.
And year 2, loss of 2,000. Year 3, 4,000. So we have it as this, 58,000. This is a loss of 2,000. And this is what? A profit of what? Of 4,000. Of 4,000. So depreciation. The depreciation value we derive is what? 62, right?
62.
And that will be same throughout the year, right?
Yes.
62. Since it's a straight line approach, this will be 62. And this will be what? 62. So your cash flow will now be what? Based on the formula we have. Cash flow will be what for year 1?
120,000.
This points
120,000.
for year 2.
60,000. 60,000.
And for year 3 to be what?
66,000.
For year 3 to be 66,000. 66,000. So with this now, can we calculate our net present value for project A? With this. So calculation of what? Of net present value. Calculation of net present value. That is NPV. NPV for project A. For project A. So now, for you to do this, you can arrange a table for that. We can have our year. We can have, it depends. You can have items or details. Details, then you can have cash flow. And more so, you can have your discount factor. Now, in the question, the discount factor given, which is the cost of capital, is what?
10%.
10%. So discount factor at 10%. And more so, when you do that, you can now have your present value. The present value. So looking at this question, your year 1, what will be the components of your year 1? Your 0 rather. Year 0.
The initial cost.
Initial outlay.
Yeah, initial outflow.
Initial outlay. And what is the value?
200,000.
It's a negative because it's an outflow. It's an outflow. So at year 1 or at year 0, what is happening? The discount factor will be what?
0.909.
One.
Is 1.00. 1.
No, year 0 is 1 now. Year 1 will be 0.90.
So let me ask a question now.
Leave this one.
Let me ask a question now. Why is year 0 always 1? Or you just come up with 1 every time? You must know.
Anything rescue.
Okay. You know, it's not just 1. I know it's 1, but why is it 1? Have you asked yourself why it is 1? You've not asked yourself.
Because that was the year of investments, or the year that they invested the amount.
Okay, can you come again, ma?
Yeah.
I said it's because it's the year that the investment was done, or the year they try to invest, they try to do the investment. So it's always at the beginning.
All right. Yes, Madam Victoria, is that a mistake or?
Because it's raised to power 0, and anything raised to power 0 is 1.
Okay, that is nice. All right. So the point is this. At year 0, at year 0, at year 0, at year 0, the investment is taking place at before operations now. All those costs you incur before operations, before the business starts fully, there are, well, I would say, pre-investment costs, such as research, all those things, research and development, all those activities that are taking place before operation. The costs are incurred immediately, and they are not forward-looking. So the money you are paying now is equivalent to the time value. And that is why you don't need to discount that value or that money. You don't need to discount it. Immediately you are paying it, and it is before operation, before year 1. So as at the beginning or before the operation commence. So, and that is why it is always 1, because the time value of that money is at the present, is at now. It is not looking at the future. It is when it is looking at the future, you are looking at year 1, you are looking at year 2 ending, then you will not need to do what? You will not need to discount. But when you are incurring the cost now without any delay, it means the value of 1 naira now, you are buying something for 1 naira, the value of that 1 naira is what you are getting now. So there is no need to do any discounts on it. There's no need for you to discount the 1 naira as at today, because you are spending it now. It is when you are looking at what will be the value of 1 naira at the end of 1 year, the value of 2 naira at the end of the 4th year, then you do what? You discount. But where you are incurring the cost now, you don't discount it. And that is why it is always 1. So 1 times 200,000 will still give you what?
200,000.
So that is why at year 0, the discount factor is what? Is 1. 1. So what will be the present class? What will be the present value as at this point?
400.
It will be 200.
Not
And you know it's
200.
an outflow. You know it's an outflow, and that is why it is in what? It is in brackets. So now, for year 1, this cash flow is an inflow, and it will occur. You'll be able to ascertain it as at the end of what? Of year 1. You'll be able to ascertain it as at the end of that year. And that is why there will be need for you to do what? To discount it. But when it is at the beginning, before operations at that year 0, then there is no need for discount. The discount value will be 1. So, but for you to ascertain your cash inflow, you must have concluded that particular year as at the end of that year. So now, the cash inflow for year 1 is what? The cash flow for year 1 is what?
120,000.
120,000.
120,000.
120,000. So what will be the discount factor for year one?
0.909.
0.9091.
9.
Okay.
Wow.
Let us maintain 3 decimal places. 0.909. So the present value will be what?
Present value is
080.
109,080. For year two, the cash flow. Cash flow is what?
60,000.
60,000. The discount factor will be what?
0.826.
And the present value will be what?
49584.
49560.
Oh,
So
49584. Yeah.
this is how the class should move at this tempo. But let me stop at this point. Who is not getting what we are doing? You are not getting it. Just raise up your hand. You are not getting it. You don't know how we arrive at 109,080. You are just looking. This thing is not clear. What kind of thing is this? Just raise up your hand. Or you can just send me a message on WhatsApp, a private message, in case you don't want to raise up your hand. So I will know. So it means everybody is getting it. I'm not seeing any message. Because you must get it. For year three, so you should be ahead of me. Yes, in solving this.
Sir, please, is 3 decimal points better than using 4 decimal points? Because so I will not be as if you are using 4 at the end of the day, you will not get the answer.
There is no anyone that is superior to the other. It is you that will be consistent with what you want to do. You don't use 3 in 1 and come to 2 and use 4 decimal places. So once you adopt a decimal point, a decimal place, get consistent with it, and your answer will be within the same range. For somebody using 3 decimal
Please,
places,
leave this room, please.
4 decimal place. So there is no anyone that is superior to another. So just be comfortable and adopt a particular decimal place for your workings, and you'll be fine. If me and you were in the same hall, your own, you might be using 3, I might be using 4. The examiner knows what you are doing. We mark the steps and they know where you arrive at. You understand? So there is no any issue about the decimal points values. So
Okay, sir.
yes. So the cash flow for year 3,
6,000.
66,000. 66,000. And the discount factor at 10%.
0.751.
And the present value will be what?
45,000.
49,566.
49,566. Is that all, please?
Yes.
0.7. Yeah, that's all.
So what will be the next thing? Looking at the question.
Scrap value. Scrap value.
Okay, these people are prepared for this exam. Scrap value. Somebody should ask, why are we bringing scrap value here?
Don't come. No return back to you. Please go.
Why are we bringing scrap value here?
Because it's an income.
As at when?
It's at the end of year 3.
Yes.
Very good. That is the approach. Is an income as at the end of year 3. So we are bringing it in. And how much are we getting?
14,000.
14,000. 14,000. So the discount factor will still be what? And what will be the results at this point?
$10514.
10514. So the net present value will now be what?
18,720.
So the MPV will be equal to what? 18,720. Who is not getting 18,720? Who is not getting it? Mr. Udu, hope you've gotten it because I can see your calculator.
I'm punching. I'm punching it here.
Annoyance.
18,720. Yeah.
Just punch it softly, sir.
18,720. Yeah.
So can we quickly solve for project B?
Yes.
For project B, you know you will start from this point. You must know what your depreciation is. You start from this point, you move in that direction. So this is revision class. I have your time. So I'm not running anywhere. So depreciation for project B will be what?
36,000.
36,000.
Fine, 36,000. So can you now solve for your cash flow?
Yes.
72,000. 1.
For year 1. Okay, fine.
When I take a easy, we dey come.
Year 2, 32,000.
Yes.
Year 3, 44,000.
Oh, yes. So you can now proceed to your table now, right?
Yes.
And determine your MPV.
Done.
Easy now.
NPV 13,936.
13,936.
Super seriously.
Now, wow.
Now, you guys, you saw this before.
Now, teach me this with that fastness.
You want to give them extra sheet.
So hope everybody's getting what you understand what you are doing, right?
Yes, sir.
If you can still move slowly and don't mind some of us that are very fast, yes. But the concept is learning curve. As you practice at home, you learn fastness too. Yes, so that you not go to the hall. 3 hours is just like 1 hour in the hall. Yes, so that you not say, I know this thing, no, but time no day.
Please, I need a question.
The question is,
Just open the question, please. Thank you.
so the question says calculate for each project the net present value, in which some of us have actually ascertained. So for the internal rate of return, the question is, before we move to that, what is internal rate of return?
Good evening, sir.
Thank you, sir.
Yeah, with regard to the rates that equate the present value cash inflow and the present value cash outflow of a particular project.
Okay. And when they both equate, the result will be what? When your outflow is equal to your inflow, outflow is negative, right? Inflow is positive. When they are both equal, but with negative and positive, the result will be what?
Zero.
The result will be what? 0. So the internal rate of return, this is the rate that equates the net present value of expected future cash flows to 0. And more so, it can be defined as the discount rate at which the net present value of all cash flows is equal to the initial investment. So it is the maximum cost of capital that can be applied to finance a project without causing harm to the shareholders. So another point is this: take note, so that when you go to the hall, you are seeing them using another word. Internal rate of return is also known as what? Discounted factor yield or internal yield. Take note. It can also be referred to as what? Discounted rate of return. It can be referred to as what? Break-even rate. It can be referred to as what? Market discount rate.
Let them use familiar one. Now, which one be break-even rate, discounted factor yield?
Yes, I don't want you to be to be to be stranded in the hall. That is why I'm saying all this, so that when you see it, you know what you are expected to do. Yes. So the internal rate of return is also known as the discounted factor yield, internal yield, discounted rate of return, break-even rate, or market discount rate. If you look at, sorry, this is FM class, but there is a question in performance management where they want you to solve internal rate of return. But in that question, they didn't make it clear that determine the internal rate of return. They said determine what? The break-even rate. So somebody like just saying that for the first time, we dumbfounded. What is this again? So you must know the synonyms associated with some of these key terms, some of these words. So how do you compute internal rate of return? Somebody should tell me. Revision class.
Hello, sir.
I'm with you, sir.
Yeah, the first thing we have to determine the present value and to see if the present value is either positive and negative. If it is positive, then you have to determine the present value in negative. Then if it is also negative, you have to determine the present value in positive.
All right, fine. Let's take it further. Let's now assume I'm using 15% as my discount factor, and overall, my NPV results to a positive value. I'm using 15%, and I have an NPV which results into positive. How will I be able to determine an appropriate discount factor that will result into a negative MPV for me to be happy with myself?
I think the NPV will be high. Maybe we'll use 30%.
Would the rate?
We use lower MP. Yeah, this thing discount Reduce rate. the
We use higher MPV.
Okay, some people are saying higher, some people are saying lower. I want you
No,
to know.
We'll use a high
if you
rate.
get first
If you
one,
get close,
if you get
it is
positive one,
advantageous
for you to get negative, you go for higher rates.
MPV.
All right, fine. If you've used discount factor and you are getting a positive value, for you to get a negative value, you increase your discount factor. You increase your discount factor. You increase your discount factor. So it is also called the trial and error approach. You use the trial and error approach to determine those values. So having done that, when you determine your positive MPV and negative MPV, what will be the next thing?
You calculate
Using what?
the formula.
And what is the
The
formula?
formula.
The formula is A plus
Lower rate plus
plus
MPV positive
A
divided
all
by
over
MPV positive plus MPV negative, open brackets, higher rates plus lower rates, minus lower rates rather. Close
This
that
bracket.
man
is
is this man is set. He's just waiting for the exam paper now.
it.
All right. So based on the question, we had to calculate for each project the approximate internal rate of return. So we need to calculate two opposing MPVs. Two opposing MPVs, which is one will be positive and one will be what? Negative.
Negative.
So for the first instance, we are going to do what? We are going to do what? I'm going to assume 15%. Let me assume 15% for me to get for project A. Now I want to solve for project A. Then you quickly tell us what to do for project B. I'll assume 15% for project A. Let's show that working, solving for internal rate of return. I'll just do a simple note here. Calculate or calculation. This is just like a way of revision. Some of those things we've learned so that for now, so calculation of internal rates of return.
Hello, Mr. Tope.
I'm with you, sir.
So based on this assumption, there is going to probably at the end of the day we may not get the same IRR because of the assumption.
Very well.
Is there any effect on that?
No effect on that, sir. And that is why it is called trial and error approach, sir. But all things being equal, sir. All things being equal, your IRR and my internal rate of return should be almost within the same range. Yes, all things being equal. That is, if you want to test further, in which I think we tested for one of the class, we have 0, and in one of the class we didn't get 0. Somebody quickly computed it and discovered we didn't get 0. So, but when we solve now, some of you will use another value, some will use another value. Then we'll see the end result. We'll see the end result. You discover that if you are getting 16%, somebody else might be getting, let's say, 16.5 or 17%, almost within same range. But our answer might not be perfectly the same. But we'll try something now. Yes. So calculation of internal rates of return. Calculation of internal rate of return. This internal rate of return, it is used as it is used to compute cost of equity also, right? If you reflect back, so the point is this: in calculating your IRR, in calculating internal rate of return, the most important thing to do, the most important thing that you need to do is to assume two discount rates. That will produce two opposing NPVs. That is positive NPV and negative NPV. And what will you do? And input the results. In what? In the internal rate of return formula. So in this question, first, I want to assume 15%. It's not far-fetched from what we've done before, but in this case, you use two discount factor, then you substitute into the formula. So assume 15%. So we have
Sir,
the year.
Is there any metrics to know whether to go higher or lower? So assuming now that this project
That is the metric we just explained. That is the metric we just explained. That, for example, if you are using 5% now, and you have a positive result, what will happen? You increase to, let's say, 8%. Yes, and you are likely to get a negative figure. Yes, you can do that and might not get a negative figure. It shows that you still need to increase the value, the discount factor.
Okay, sir, but assuming we have a negative NPV already from this project, so it would have been better we reduced, that is going by 8.5 instead of going up, as we already have 10 before.
Yes, you can do that, but I don't want. Yes, you can do that. Fine.
No.
Yes, here we already have. Yes, you can just, at this point now, what will you do? Since you have a positive NPV using 10%, you go what?
We go higher.
You go higher.
Okay, sir.
You go higher. Yes. So now, coming back here, we have our details. And here we have our cash flow. And here we have our discount factor. You're trying to see, instead of solving again, just use that one as a positive table and move on. It's fine. So we have here 0, we have 1, we have here 3, year 2, and also we have year 3 and year 3 likewise. So I think we are going to have same. Okay, no, my discount factor is different. So my result here, this is initial outlay. The cash flow is what? 200,000. And the discount factor, year 0 is 1. And this will be what? 200,000. And for year 1, our cash flow will be what? 120. Isn't it? For project A, cash flow is 120. And the discount factor will be what? Based on 15%.
0.870.
And the present value will be what? Should be 62. Oh, no, this is 2 now. Should be 104.
400.
400. And for this, the cash flow, this point will be 60,000. And the discount factor will be what?
0.756.
And you multiply the PV, will give you what?
45,360.
And for year 3, we have our cash flow to be what? This is 66,000. And the result here, it should be 15%, 1.15, 0.658. And this will give us what? By 66, should give us
43,428.
428. And the scrap value, this scrap value is 14,000. And this will be 0.658. And the result here will be what? So the MPV will be what? And to do a plus and minus.
Six
So you should have to,
negative 6,400.
is it negative?
Yes, I got negative. Another person should. No. I not calculate it well.
2,400.
2,400. It should be negative because the total inflow
It's
is
negative.
Okay,
Negative
fine.
2,400.
Yeah.
Negative, fine. Negative 2,400, right?
Yes, sir.
Negative 2,400.
Please, I'm having positive
Me
2,400.
too, I'm having positive. I'm calculating it.
It's positive 2,400.
It's positive. Positive 24.
I have
Inflow is
It's
more than the
positive.
outflow.
12,400.
That is
My
positive.
total positive.
So, you know, at this point in time, you have to check your calculator very well. If you are still borrowing calculator, go and get you. You know, some people, it is 2 days to the exam, they will go to the market and be looking for calculator. You need to get used to your calculator.
If I talk about for the total of the present value is 202,400, and we have
Yeah,
the
yeah,
initial outlay of 200,000. We have a
200.
negative. We have a negative net MPV of 24. If you add these cash flows to the scrap, you have 202,400, and the initial outlay is 200. So have negative. Okay, sorry. It's
Positive.
positive
The
too. Yes, it's
positive is
positive.
greater than the
It's
negative.
positive.
Yes, it's positive. It's positive.
So, what are we going to do now?
We
To get
will
the
need to increase our discount factor.
Me, I will increase my own to 20%. Please don't go and increase it. Somebody increased during the class exercise. Somebody was increasing it to 90. Don't.
The president don't want to be going back and forth.
Mr. Tope, please, what if we just double it?
Fine, no problem. If you double it and you solve and you are able to derive a negative value, fine. So you want to say something?
Yeah, what I to check myself, especially when in exam mode. If I have
Mr.
positive MPV, I will have 10%. If I have negative, I will have 10%. That 10% will automatically give you what you want.
All right, fine. So this is a clue.
Mr. Tokpe, please let me ask my question. You just said something concerning increasing to 99%. Sir, can you hear me?
Watch the video again.
Yes, we can hear you.
I can hear you, please.
Is it not okay like that? It's not advisable. Instead of solving and looking for negative.
It's too much now.
It's too much.
No, I have settings now.
No,
I
you
think
don't
the
need
best
It's
to.
not
thing
okay
to
like that.
increase it to 40%, 50.
It's not okay like that. Just if you use 5% and you were able to derive let's say a positive value, it is very reasonable that once you double 5 to 10, you should be able to get a negative value. Yes. So you don't need to go to the point of using 60%, 90%. It's too, the margin is, you've gone far. Yes. So you can just double, just as Mr. Emmanuel have said, you can just double that value that is giving you a positive value. If 5 is giving you positive, double it to 10%, make it 10% and try. It should give you a negative value. Yes, so we don't need to go to using 90, all those things like that. Like for this now, I won't double. I will just add 5%. Let's see. Yeah, I don't want to double now. It's a trial, that's why it's called trial and error. Yes, but you don't need to go 90, that's range. So I want to assume 20%. Somebody else can assume 30%. Yes, and let's see. I want to assume
I've used 20% and I've got negative.
you assume 20%, right?
Yes. 10% and
Okay.
20%. I use 10% to get the positive and now 20 to get the negative.
Yeah. So you see now. So let's now show it generally now. So still, I still have all these values here. Writing over and over again. I still have all these values. Let's copy this. Still have all these values, but I'm assuming 20% here. Using 20% here. I'm deleting all this. So now, if I'm using 20%, my discount factor for year one will be what? Year zero is settled already. For year one,
833.
0.833. Then the PV will be what? Should be, yes, 99960. Then for year two, your discount factor based on 20% will give you what?
0.694.
0.694. And the present value will be what?
41,640.
And for year three, the discount factor at 20%.
0.578.
0.579.
78. Okay, 9.
And the result here will be what? 660579 should be 38.
That's 8148.
Is it 148 or 214?
8214.
Okay, 214, sorry.
0.579 multiplied by 14,000. Mm.
8106.
So your MPV will be what?
Negative 12,018 naira.
Negative 7,640.
Okay. You are using what rate? Person with 7,000.
Negative 13431. 80,000. 20%.
Okay, you should have what we're having on the screen.
Negative 12,018 naira.
13431. So I haven't done this. Who is not getting what we have here so that you will not just in this class? Mr. Shegun, are you with us? Mr. Shegun is not here. Mr. Vestos, are you in this class? I'm looking at the list of people in the class. You know. Okay. So can we solve, if you know you understand the internal rate of return formula, can you substitute these values into the formula and let's get the results? What will be your internal rate of return for project A?
I got 16%.
What is there? Who else is getting 16%?
I got 15.83, then approximately
16%. Okay, sir. Project A, internal rate of return. You know your formula, right? Depending on how you want to interpret it, and the A plus, depending on your interpretation. Who else is getting 16%?
I got 15%.
16%.
Yes.
Fine. If you are not getting 60%, can I see your hand? Or you don't even know how we arrive at 16%? Madam Lucy, do you have 16%? Or you are still solving?
No, sir, I didn't work like this, so no chance to solve. I'm just listening.
Oh, wow. You need to make money. That's it.
Honestly, the end goal is to make money.
So everybody is getting 16%. I'm asking because I don't want to. I want to move to the next thing.
Yes, I got 16%.
But fine.
Yes, I
So,
got 16%.
fine. Everybody is having 16%. So at this point, everybody should be able to solve.
I got 16%. Though I use 16%. I use 18 for my eyes. Not because, but to get the negative value, I use 18% instead of the 20%. Or the 20% you use that. They I got the same answer. I got the same answer with your son.
All right, fine. Fine. So this is revision. So talking about the payback period, in relation to this question, what do you think we are going to do? I'm not solving for the B because it's still the same thing, the same process. Yes, for project B in terms of internal rate of return. The major thing is you understanding what we're doing. So talking about the payback period in relation to this question, you've invested 200,000 and payback period has to do with what? When you recoup back your what? Your investment from your cash inflows. So to determine payback period for project A, I'll solve for project A, you solve for project B. Payback period. That is calculating payback period.
Hello, sir.
And which is sir?
Will you be an offense if I draw you back?
No problem, sir.
Let me know where I'm not getting it. That's IRR.
All right, sir.
That's lower rate 10.
Your lower rate is 15, right?
No 10. Okay, we used no wonder. Okay.
Then your plus your MPV of lower rates, which is 2,400, divide by MPV of lower
It's
rates.
okay, sir. Yeah,
2,400.
I've seen my mistake. Sorry. Thank you, sir.
Right. So calculating payback period for project A. For project A. I'm going to have it. I'll just use a table. Depends. Some of you might decide to do it anyway you understand. But it's good you present in a clear way. We have here Then we have I can say my details depending, and I can say my cash flow, and I can come here and say my balance depends. So as at year zero, what happened? We made an investment, initial outlay. We made an investment of how much?
200,000.
200,000. So as at that period, the balance will be 200,000. So as at year one, the end of year one, we're able to get an inflow of how much?
120,000.
120,000. So we have cash flow of 120. That 120,000, we use it to reduce our investments of
80,000.
So we have 120,000. Our balance will be what? When you say 200,000
80,000.
negative. So as at year two, our inflow is what?
60,000.
50,000.
Our cash flow is 60,000. Is this sufficient to offset this value?
No.
No. We still have 20,000. So as at year three, what do we have?
62,000.
We have cash flow of 66,000. At this point, I think we should be fine, right?
46,000.
Positive
46,000.
46,000.
46,000. It means we are free as at this point. So, as at when are we able to recoup back the 200,000? As at when?
Second year, 3 months and 6 days.
Okay, second year, 3 months and 6 days. Okay, how do we get that?
To get the number of months and days, that's 20 divided by 66,000 multiplied by 12. Since this one has already given us 2 years, so from there we get the number of months and days.
Okay. Yes, that is fine. So we're able to recoup as at year two into some fractions, some months, cutting it into year three. Yes, some months, some fractions of months into year three. If you recall back in our class, how did we derive it? Yes, Mr. Emmanuel have given us a, yes, I've made it a point clear, and which is that way. Yes, I still want somebody to add more voice to that. Yes, to really know that you understand what we are doing. When you have it, you know, it's not a perfect value. That's okay. You recoup as at year two. So we showed something during our normal classes that once it boils down to another period, how are you going to determine? It is very clear. As at year two, we are left with negative of 20,000. So that 20,000 was offset in year three. Yes, in year three, some fraction. So can somebody else add more voice to that for emphasis purpose? Yes.
So I come agree with your question.
The question is just when is the payback period? Payback period is equal to.
It's just the duration of. Can you hear me?
Yes, I can hear you, sir.
Is it the meaning of payback period or the calculation of
The
the
calculation,
equation?
sir. The calculation from this question.
Okay, the one I calculated, I have 2.3. That is 2 years and 3 months.
Okay, 2 years and 3 months. Okay, fine. Yes. Who else is getting that? Who else is getting that?
Same here. I got that.
So the point is this: as at year 2, what is left? The balance as at year 2 is what? 20,000. Divide by what? Divide by what?
The next cash cash flow.
Yes, and that is what? 66, right?
Yes, 66.
Yes, sir.
Yes. 66. And we're going to have what?
0.3030.
You multiply by 12, you have what?
3.6.
3.6.
3.6. Okay. So we have it, let me see, 20 divided by
Yes.
2 years what?
3 months, 6 weeks.
Yes, so that is how. That is 2 years, 3 months, right?
Yes.
2 years, 3 months. Yes, 3 months. So for project B, what is our payback period? For project B, our payback
2
period.
years,
I have
2 years, 4 months.
2 years, 4 months. Okay, fine. 2 years, 4 months. The initial outlay is 120. As at year 1, we have a cash flow of what? Okay, I didn't solve for that. We have a cash flow of 72.
2,000.
So 120 minus 72, you have a negative of 48. For year 3, you should have this, you should have 32. Or for year 2, you should have 32 as your cash flow. So 48 minus 32, you have what? 16 negative. Then, as at year 3, you have what? A cash flow of what? 44. It means the settlement period will be 2 plus 16 divided by what? 44. You are not getting it. You are not getting 2 years, 4 months. You can speak out. You are not getting 2 years, 4 months. Yes. Another key aspect is the issue of accounting rate of return. Accounting rate of return. When we talk about accounting rate of return, another word for accounting rate of return is what?
Return on asset. Capital employed.
Yes, return on capital employed. The, the accounting rate of return is a non-discounted method that makes use of what? Accounting profits as shown in a company's financial statement. So it is also known as what? Return on investment or return on capital employed. So this accounting rate of return is a measure of what? It's a measure of profitability because it focuses on profits and not cash flow. Take note of that. It focuses on what? On profits and not cash flow. So there was a question, Mr. Silas, if you recall that question, I forwarded the question on the general platform, but you just solved it last week, right? Yes, and you asked a question, a personal question on that question, where the question wants you to compute accounting rate of return. Yes, I forwarded the question over time. That is an ACCA question on financial management. I know most of you have solved it. It's a very long time I forwarded the question, and I think most of you have solved. But he just solved. So he was asking a question on accounting rate of return. Why were they deducting depreciation? And the depreciation is still the value of investments because the investment was 2 million, and the depreciation is on a straight line basis. So for 4 years, it's 500,000 for each year. You can still revisit the question again in case you've not solved. I can re-forward the question. Or Mr. Salas, you can re-forward the question to the platform again for those that
All right, sir.
have,
Let me do that.
have not solved that question. I copied the question from the financial management pack of ACCA, and that is where I obtained that question. Though many have solved, but in case you still want to test your understanding, you can test your understanding on that. So the issue of accounting rate of return, it measures profitability. It looks into profitability and not the issue of what? Of cash flow. And there are various formulas for you to solve for accounting rate of return. If you look at your notes, I put a formula, like 2 or 3 formulas there, that accounting rate of return can be computed using estimated average annual profit divided by average investment. And also, how do you get your average investment? How do you get average investment?
Average investment is equal to initial capital layout plus cash value divided by 2
Yes,
plus either additional working capital.
yes, very fine. So the average investment is your initial outlay plus your residual value divided by 2. If you recall in the class, usual class, we treated that and we showed some examples related to that. And for you to get your depreciation, which we've seen, your initial outlay less your residual value divided by your useful life. Divided by your useful life. Now going back to this question on the screen, they are asking us to determine our accounting rate of return. Likewise, that we should determine our accounting rate of return. And how are we going to determine that? We're going to use our formula, estimated average annual profit. Estimated average annual profit. So calculating accounting rate of return. That is ARR. estimated average annual profit divided by estimated average investment is multiplied by 100 over 1. So for project A now, what will be your estimated average annual profit for project A? Your estimated average annual profit. How will you get your average annual profit? That is a question.
You sum up the profits for
think-
the 3 years, then divide by number of years, which is 3.
Okay, very good. Average annual profit. So for project A, what will be the results? Total profits.
20,000. We are doing this. I think 20,000.
Total profits divided by what? Number of years. Going to the question. The total profits will be what for project A? Year 1, you have 58,000, right?
Yes, sir.
Yes.
2,000, which is a loss, plus
56,000.
4,000
That is 60,000.
divided by the number of years.
3. Yeah, 3,000.
You have 20,000. So based on the formula, your average annual profit, estimated average annual profit will be what?
20,000.
Will be 20,000 divided by your estimated average investment will now be what? What will be your average investment for project A? Average investment
200,000.
It will be
200,000.
107,000.
107,000. Fine. So 200,000 plus 14. Your
14,000.
cost as at opening plus your residual value 14,000. So 200,000 plus 14 divide by what?
Divide by 2.
That's
Divide by
107,000.
107,000. 107,000. 107,000. So
That's 19%.
yeah, so 20 divided by 107,000 multiplied by 100 divided by 1. The result will be what? Should be 18.69.
90.
18.69.
18.69.
Approximately 19, right? Equals to 19%. 19%. So for project B, what would be your accounting rate of return for project B? Project B, your accounting rate of return will be what?
20.20. Hello, sir.
20 point. Yes, sir.
Hello, can you hear me?
I can hear you.
Hello?
I can hear you. I can hear you.
Okay, I see 20.20.
Yes, 20.20,
That's
yes.
20%.
Yes, that is 20%. Fine. Who is getting 20%? Likewise. Okay, fine. Fine. Yes. So the point is this. If you have solved everything like this, if you've solved everything, what is the question saying? Let's say that Lamia Limited has an estimated this, that neither project will increase the working capital of the company. The company has sufficient funds to meet all capital expenditure required. Calculate for each project. Now, once you've done your calculation for each project, for MPV, you have to calculate for A and B. You can just do a summary table that MPV for project A is this, for project B is this, the internal rate of return for project A is this, for project B is this, the payback period for project A is this, for project B is this, the payback period for, in terms of, or the accounting rate of return for project A is this, the accounting rate of return for project B is this. So the question will now be your selection. What would be the criteria for your selection? If the MPV of A is greater than that of B, which will you select?
A.
A. A. You select A. And why are you selecting A?
Because it have the highest MPV.
So the point is, both projects are very fine. Will be very fine if they have positive value. Yes. So you can just give an interpretation. Yes, that project A and B are financially viable because they have positive MPV. You give the value. Project A is having a positive MPV of this, and project B is having a positive MPV of this. But however, the two projects are, the question says mutually exclusive, right?
Yes, sir.
Yes, the two projects are mutually exclusive. So it means that project A, if project A is having a higher MPV, project A should be selected because you cannot do both at the same time. So you select the project with the highest MPV. You select the project with the highest MPV. So that is how you come up with your interpretation, because as a manager, you are not expected to just solve. The question will always, you must refer back. You must refer back to your computation. You won't just, please recap how. All right. So once you're trying to your workings, what you've solved, and give your advice based on your computation. Yes, Madam Rose, I can see your hand up. Yeah, muted in case you are talking.
Okay, I've gotten it already. I was lost somewhere, but it's okay now. It's okay now.
Yes, I want to mute you because if I'm talking and you're not muted, to re-echo. So, one of my guys said we should recap on how we arrive at this. So this is the formula to determine accounting rate of return that estimated average annual profit from the question. You are giving profit free of charge. Profit for you to go to the question and add the profits. And for project A, the profits or loss is given. This is it. Expected annual net profit or loss. Year 1 is this, year 2 is this, year 3. Add everything and minus, divide by 3. You get what? The average of the annual profits. And for investment, how do you get your investment? Your average investment, the initial outlay plus the residual value divided by 2. You get the average investment. Then you substitute into this formula. Estimated average annual profit, you have 20,000. The estimated average investment, you have 107 multiplied by 101. You have this. I don't know if this is okay. Is that fine, sir? Yes, sir. Okay, let me go back to your message so I can be. Okay, Christiana, she's a female.
Yes, sir. The network is breaking on my side.
Okay, all right. So, Madam Rose, what do you have to say? Your hand is still up. All right. Let's move to
Mr.
the
Togal, sorry, don't move on this slide. That total profit is 58,000 plus 4,000. You will not include the loss.
Who less the loss, sir?
Okay, I didn't include it. Okay.
You know, it's either you make profit or loss. And we're making a loss. It's a disadvantage to you.
Okay.
Looking at this question, this is another question. I know most of you have solved though. You've given me.
Raise my hand.
Okay, yes, Mr. Patrick.
Sir, for instance, how do you mean we are giving a profit before tax and profit before depreciation and tax?
Yes,
so how are we going to get our cash flow? Because for accounting rate of return, I know that I'm going to deduct my tax and my depreciation to get my net profit in calculating my accounting rate of return. So what about to get the net cash flow also?
To get the net, cash flow.
To get the cash flow, if
Yes.
the profit is depreciation and the profit is profit before depreciation and tax, and I was given a depreciation rate and tax rate.
Okay. Yes. You are giving depreciation and tax rate. It means for you to get your cash flow, in that case, you are giving depreciation and tax rates, and then you are giving profit before depreciation,
Yes,
isn't
sir.
it?
Yes, sir.
Profit before depreciation. It means you will
Yes,
not
sir.
need to go ahead. That profit before depreciation should be your cash flow. But I think you assume this yourself, right? You
Then I
assume
saw
those.
I saw a question on that, but the question is just based on accounting rate of return only.
Yes, it's based on account. If
So,
it is
so
easy
when
to
it's based on accounting rate of return, I just less my tax and depreciation to now
yes.
get my.
If the question wants you to solve based on NPV, based on this thing, it will give a comment, a statement. You understand? A twist somehow that will make you to know that you will need to do additional workings for you to actually get your cash flow. So they will not just give you profit before tax and depreciation. You understand? So there will be a twist, there will be a statement that will lead to you determining your cash flow without any confusion. Without any confusion, sir. So some yes, some questions will come in a way whereby, like for example, that question I asked Mr. Samson to forward to the platform. In the question, there are certain twists in that question whereby the examiner is putting certain things first. There was issue of profits. There was issue of profits, and you are expected to compute MPV. At some point, you are expected to compute accounting rate of return. Accounting rate of return on that question. So there will always be an information when you read clearly telling you what to do per time. I can see your hand up, sir. Mr. Patrick. Okay.
Yeah, it's fine. It's fine, sir. It's fine.
So looking at this question, can somebody interpret this question on Kings? You've solved. I asked everybody to read, and you've sent your attempts to me. Well appreciated. So can we analyze this question? That this
Your
question
screen is not showing. No. Thank you, sir.
I didn't touch it. It's your network, man.
It's okay now. It's showing now. Thank you.
In case it didn't show again, it's not from me. It's from you. So the point is this. This is a question. This question is from the pilot question. I can upload it on their site. Yes, from the financial management. I downloaded the question, so I decided to forward this to the platform so that we can have a feel of what questions you are likely to come across, how it will look like, and that is why I decided to put this forth to the platform. I will still send more. I'll send another one on cost of capital. Yes. But looking at this question, based on your analysis, what can you tell us? How can you interpret all this? Somebody should speak to this question. Because in the exam hall, you will speak to the question. So speak to this now. Yes, yes, yes. I need a female now to talk. You know, Mr. Patrick has been taking the leads. Mr. Sampson have been talking. So, you know, in ICANN, we're always gender sensitive. So we want to balance it. Yeah, somebody should speak to it very fast so that we can go. People don't want to talk. All right. So looking at this question, that Kings Limited is a listed company that has built up an excellent reputation in Lagos. All right, Mr. Sampson. I'm with you, sir. Can see your hand up.
Okay, I don't know. You said someone should explain a bit.
Yes, I don't.
All right, sir. Okay, I think based on my little understanding about the question, I think whenever we are asked to solve for NPV that has a multiple variables like sales revenue, tax, capital allowance, and other variables, we are expected to use the tabular method, whereby we determine the revenue, then our cost, which comprises of the variable cost and the fixed cost. So after that, we will write our profit. If tax is being given, then we now deduct our tax expense. Then other cash item, maybe taxes on capital allowance, a residual value, a working capital, if there is any, we also adjust for it before arriving at our net cash flow. Then after arriving at our net cash flow, we now use this thing, the discounting factor of whichever one that is given to us to arrive at our NPV. That's my little number.
All right, thank you very much for that. Yes. So he has put it right. So looking at this question, that Kings Limited is a listed company that has built up an excellent reputation in Lagos as a manufacturer of smart space-saving furniture that has proved very popular with young people who often live in small apartments. As a growth strategy, the board of directors has decided to expand the company's operation by establishing a factory in Abuja. Their intention is to invest in a small temporary factory that will have a useful life of what? Of 4 years. It means whatever you're doing is within this space of 4 years, useful life of 4 years. The performance after 4 years will then aid the board to decide on whether to invest in a permanent factory or discontinue with the Abuja expansion strategy. So a visibility study carried out by the Finance Director Office has produced the following information. One, that the initial investment in the small temporary factory will be 12 million, and the residual value after 4 years will be what? 4.5 million. What is the interpretation of this? It means at year zero, you are investing how much?
12 million.
At the end of 4 years, you will get an inflow of what?
4.5 million.
4.5 million. 4. That tax allowable depreciation will be claimed at an annual rate of 25%, reducing balance in years 1 to 3. At the end of year 4, any remaining written down value will be claimed as a balancing adjustment. Now, in solving for NPV, do you consider depreciation as part of your workings? Do you consider depreciation as part of your workings?
No, sir.
Is no. But you need to get depreciation to be able to determine what? Your tax savings. Tax savings is a cash inflow that helps you to reduce the amount of tax you have to pay. So the question is, how do you get your tax savings? You get your tax savings by multiplying your tax rate by your depreciation value. By your depreciation value. So looking at this question, if you invest 12 million and your depreciation rate is 25%. As at year one, what will be your depreciation? 12 million multiplied by 25%. As at year one, what will be your depreciation? 25% of 12 million will give you what?
3,000.
3 million.
3 million.
Yeah, sorry.
So 3 million
3
will be
million.
your depreciation. So what will be your written down value, or what we call net book value now?
8 million.
To be 9 million.
9 million, sorry.
9 million. Then your tax savings will now be what? I said tax savings is depreciation multiplied by tax rates. Your tax savings will be what?
What's tax rate? I can't see.
If the tax rate is
Okay.
30%, that's 900.
Let's go to the question. The tax rate is there.
Okay, the tax rate is 20%.
Yes,
That's
tax
not-
rate 20%.
That's
20%. 600.
Fine. Tax savings is 600. That is for year one. Take note. Now, if we are using reducing balancing, you're going to charge 25% on what? In year two.
9,000. 9,000.
9
9
million.
million.
So it will be 25% of what? 9 million.
2 million 250.
That will be your depreciation for year two.
Yes.
So what will be your net book value or your written down value now?
Written down value will be 6 million 750.
6,750. And your tax savings will be what?
$450. 450,000.
450. Fine. 450. So for year three, based on reducing balancing, it will be 25% of what?
6750.
6750. So once you do that, the result will now be what?
1 million 687,500.
1,687,500. So your written down value as at that point will now be
6
So please, can you write this one down?
Don't worry, I'll write it down. Don't worry. I know it's confusing.
Thank you.
I'll write it down, but I won't be able to solve the whole question. I'll forward the solution to the platform. But let me just show this. So what do you have as at year three, the written down value? So let me just say this as to buttress these points. When we talk about tax allowable depreciation, it is also known as what? Sometimes it's called capital allowance. And tax allowable depreciation is the depreciation recognized for tax purposes, not for accounting purpose. So it is a tax deduction allowed by law to companies that invest in qualifying assets such as plant, machineries, or equipment. And it is not an actual cash expense. Take note, it is not an actual cash expense, but it reduces what? Taxable profit, and thereby reducing what we call tax liability. So what it does is that it creates a tax savings otherwise known as what? Tax shield. Tax shield. And that tax savings is recognized as an inflow. And that is why we need to determine that value of tax savings, because it will be used in our computation. So tax savings on tax allowable depreciation in year one, using reducing balancing method, in year one, the value of our investment as at year one is what? 12 million.
12 million.
12 million. 25% depreciation, reducing balancing method,
3
0.25.
million. 3 million.
10 million. So depreciation. Depreciation, 3 million. 3 million. So your written down value or net book value
9 million.
will be what?
9 million.
That is 12 million minus 3 million. You have 9 million. So your tax savings is what?
600,000.
Tax savings. Somebody, how do you get 600,000? It is what? Your tax, 0.2 multiplied by what? 3 million. And the results will give you what? 600,000. So since you are using reducing balance in year two, what value are you going to use? It will be
25% on 9,000.
yes, your written down value, your net book value, as at the end of year one, will come as the value in year two. That is 9 million multiplied by what?
25%.
0.25. And the result will be what?
2,250,000.
This is the depreciation. So your net book value, your written down value will now be what? As at the end, six.
6,750,000.
So your tax savings will now be what?
450,000.
450,000. So in year three, your depreciation based on reducing balancing will be based on what value?
25% on 6,750,000.
6,750 multiplied by 0.25. And the result here will be what?
1,687,500.
687.
500.
500. And your written down value will now be what?
$5,062,500.
And this, your tax savings, 30%, 20% on depreciation.
3,337,500.
500. On the question, let's read something that tax allowable depreciation will be claimed at an annual rate of what? 25%, reducing balancing in years 1 to 3. At the end of year 4, any remaining written down value will be claimed as a balancing adjustment. Will be claimed as a balancing adjustment. Now, as at the end of year 4, our value is what for year 4?
5 million. The written down value.
The written down value.
5,062,500.
5,062,500. Now, take note. As at the end of year 4, your residual value is what?
4.5, I guess.
4.5. 4.5. So we must note that if at the end of the asset life, when you compare the remaining written down value with the residual value or scrap value, and the written down value is greater than the residual value, it means you have what? You have balancing allowance. You have a balancing allowance. It means what? There will be,
Balancing allowance.
yes, there will be extra deduction in terms of tax. Let's see. In terms of tax saving, there will be extra deduction in terms of tax savings. Okay, yes, fine. So it means that, but on the other hand, if the written down value is less than the residual value, what allowance? On the other hand, if the balance is greater than residual value, but if residual value is greater than the balance, what will you have?
Balancing charge.
Balancing charge.
Balancing charge. Fine, balancing charge. So in this case now, as at this period, your written down value is this 506 to 500. As at the end of year 4, the scrap value is what? Scrap value
4.5.
4.5.
There is a question I forwarded related to this sometimes. All those small assignments I was giving. There was a question that requires you to do this. If you can reflect back, you see that assignment. So the scrap value is 4.5. When you less 4.5 from the balance, are you having a positive value or a negative value?
Positive value.
And that positive value is termed as what?
Balancing.
It's termed as balancing
allowance.
balancing allowance. But where the scrap value is greater than the written down value, balancing charge. So when you do this, you have 562
500.
500. Since it's a balancing allowance, it means there is still tax savings you can enjoy from it. And what is that value of tax savings?
112,500.
112,000.
500.
Yes, you can speak on.
Okay, sir. What of in a scenario whereby our residual value is 0 and we have balancing we still have a tax system value for the last year. So how do you go about it?
That our residual value is 0 and we still have balance,
Like
right?
it was not given, it was that is not given.
If it is not given, it's there should be a statement. If your balancing is your scrap value is nil, it means you will still charge your tax savings on that final value in year 4. It means if your scrap value is 0 instead of 4.5 is 0, your balancing, it means you still have balance allowance, is a positive value. So it means you still enjoy tax savings of 20% on what? On 506 to 500.
All right, sir. Thank you, sir.
So still looking at the question, let's go back to the question again. That sales revenue in year 1 is expected to be what? 7.9 million. And this is expected to increase at 5% per year in each year's 2 to 4. It means in year 1, your sales revenue is what?
7.9.
Your sales revenue is 7.9. So the statement is now saying that it is expected to increase at 5% per year. So year 2, what will be the sales revenue? If year 1 is 7.9.
8.295.
Okay, 8.295. 8.295. Let's show it a little. So all these are the cumulative effects of some of the things we've learned over time, talking about money cash flow, real cash flow, all those issues. So your sales revenue, that in year 1 is expected to be 7.9 M. Once you see something in million, you can just multiply by 1 million to get the whole value, in case you don't want to work based on 7.9 like that. You multiply by 1 million to get the whole value. But 7.9, if this is the value in year 1, in year 2, what will be the value? In year 2, expected to increase by 5%. So 1.2, me, I'll just say 1.05 multiplied by 7.9.
8.295.
8.295. So 1.05 multiplied by 7.9. We have it as what? 8.295. So in year 3, what will be your results?
8.70.
Multiplied by
Multiplied by 8.295.
8.295. Then we have it as what? 8.70. So in year 4, to be equal to what? 1.05.
8.70 equals to 9.14.
9.14. So this will be our sales revenue for year 1 to year 4. That is how the treatment will be. Then for the operating costs, that operating costs are expected to be 5.2 million in year 1. The pre-inflation amounts of year 2 to 4 are given below, as are the annual inflation rates for operating costs in each year 2 to 4. It means that in year 1, the operating costs will be 5.2 million, clearly given. In year 2, we have an amount with an inflation rate of 6%. So what will happen? What will be the operating cost in year 2? If the inflation rate will be 6%.
That's 5.671.
5.671. Operating costs. Operating cost. Operating cost. So for year 1, The value is what? For year one, the value is 5.2. 5.2 million. For year two, the value, the pre-inflation value is given as 5.35. When you apply the inflation of 6%, 6% is same as, it means there will be an increase to the tune of 6%. So it will be 1.06. When you multiply that, you have what?
5.671.
5.671.
Then in year three, the pre-inflation value is given as what? 5.66. What is the inflation rate? 7%, 1.07. We have it as what?
0.56.
6.056.
6.056. Then in year four, the pre-inflation value is given as 6.03. So when you now apply inflation, the inflation rate is given as what? 8%. That is 1.08. The result will give you
6.512.
6.512. So this is the treatment to that particular line of information.
Question?
Okay, what is the question, sir?
Is that place we are having inflation? I
Yes,
was
sir.
thinking that 6% year two, 7% year three, and 8% year four was the increment. There is the increase. Why adding one again to it? Annual inflation rate. I know that there is an increase, but I was thinking that they've done us good by increasing it by 6, 7, 8.
Okay, sir. 6% of 5.35 is what, sir? When you get it, add it back to 5.35.
6% of 5.35.
Yes.
0.321.
Add it to 5.35. You get what?
5.35. 5.671.
Fine. That is how to treat increments. So the short way is just, this I know is increase. I will just say 1.06. Yes.
Okay.
So now, it is anticipated that the working capital of 20% of sales revenue will be needed at the start of each year. At the start of each year, that the working capital of 20% of sales revenue will be needed at the start of each year. At the end of the project, it is expected that all the accumulated working capital will be released. So the point is this. You need to ask yourself, what is working capital? You need working capital to kickstart your business. It means before you start operation, you need working capital to get your inventory. And that is why this working capital must be in place before the year operations. And that is why they are not telling you that at the beginning, it means before year one, as at the beginning of year one. As at the beginning of year one, as at the beginning of year one, you should have your stocks. You should have your wares that you want to trade in that will bring inflow, that will bring profit to you. So the statement is now telling you that as at the end, the accumulated working capital will be released. It means as at the end of the project life, there will be no need for working capital again. Every working capital that have been tied up to one thing or the other should be released as at the end of the 4th year. So as sales increase each year, working capital is required. As we have increase in sales, we need more working capital. We need more working capital. So the question is now saying that it is anticipated that the working capital of 20% of sales revenue will be needed at the start of each year. So the start of year 1 will be 0, year 0. Start of year 2 will be the end of year 1. The start of year 3 will be the end of year 2. The start of year 4 will be the end of year 3. So the point is this: the working capital. How do you determine the working capital? That 20% of sales. 20% of sales. Let's go back there to our workings.
Sir, please, can you just recap that explanation? Sorry.
That it is anticipated that the working capital of 20% of sales revenue will be needed at the start of each year. At the start of each year. It means before you start operation, you should have your working capital present. Your working capital is what you need for day-to-day operation of the business. So when you are referring to start of year 1, it means as at the end of year 0. If you are to put those values as at year 1, it means it is at the end of year 1. So the start of year 1 is the end of year 0. The start of year 2 is the end of what? Of year 1. And the start of year 3 is the end of year 2. And that is why when we place the value, you will see the placement of the value, that for me to get the value of year 1, it will be the value I have in year 0. And for me to get the value of year 1, I would need to get, let me present it in a table. It's much more clear. But the first point you must be able to deduce is this: that what is 20% of sales revenue at the start of the year? That is the first thing you must be able to deduce. So 20% of year 1 sales revenue is what? 20% of year 1 sales revenue is what? You must be able to determine that. That is 0.2 multiplied by 7.9.
That's
1.5.
Working capital. Working capital. So yes. Year 0, year 1, year 2, year 3. Let's see year 4. Year 4. So that our working capital will be based on what? On sales. On sales. 20% of sales. 20% of sales. So year one sales is what? 7.9, right? Multiply by 0.2 to give you what?
1.58.
1.58. 1.58. 1.58. So year two sales, 20% of it is what?
1.659.
That is what's this value here? 8.295. 8.295 multiplied by what? 0.2. You have it as what? 1.695, right?
1.659.
659. Then year three, the value will be what? 8.70 multiplied by 0.2. The result will be what?
1.74.
1.74. And for year four, to be what? 9.14 multiplied by 0.2. Give us what?
1.828.
828. So these are the working capital based on the sales. But let's go back to the question again. That's the question is saying that the question is saying that it is anticipated that the working capital of 20% sales revenue will be needed at the start of each year. At the start of each year. The start of year one is at what period? The start of year one is at when?
Year zero, initial starting now.
The start of year one is at this year zero. That is the ending of year zero is the start of year one. I don't know if we are getting that. Just like the closing stock, let me bring it that way. The closing stock as at the end of 31st December 2024 is the opening of what? Of 1st January 2025. So the start of year one is the end of year zero. So the question is saying that it is anticipated that the working capital of 20% of sales revenue will be needed at the start of each year. So now, what is the working capital value, which is 20% of the sales, as at the start of year one, based on this computation?
That's balance at year zero minus balance at year one.
Okay.
That's negative 1.58.
Negative 1.58. 1.58. That is, there was nothing in what? There was nothing in year zero as at the end of year zero, but zero minus, that is an incremental effect now. Incremental effect. 0 minus 1.58. You have what? minus 1.58. Minus 1.58. It means this value here, 1.58, is what? Is the value as at what? As at the end of year 0. I don't know if you are getting this. Are we following? Oh, yeah.
Yes,
Oh, yeah.
Yeah.
Oh, you are tired.
No, we are not, but he's doing me why. But God is in control.
Do we have a zero?
So that's it is anticipated that the working capital of 20% of sales revenue will be needed at the start of each year. At the start of each year. So 20% of the sales revenue of year 1, which is 1.50, as at the beginning of that year, which is as at the end of year 0, which will serve as the beginning of year 1, the value will be what? Will be 1.58. 1.58. Now, the point is this: there will be an incremental value because the cash flow in year 1 or the working capital in year 1, as at the beginning of year 1, is not everything. Is not everything that you still need to get. All you need to do is to get addition. As sales increase, you get additional working capital to complement the increase in sales. So if you look at what we've done in our sales, in computing our sales value, our sales value increased by 5%. Increased by 5%. So your working capital will be the increase that results from each year's sales. So if you want to get the value of working capital as at the end of year 1, as at the end of year 1, or as at the beginning of year 1, what will happen? What will happen as at this point now? It will be the difference between this value, 1.659 minus 1.58. What is the difference? Let me see. Oh, okay, sorry. The sales value, 20.5, yes. That is 1.659 minus 1.58.
0.07.
0.079. 0.079. 1.659 minus 1.58. That increment is what you are factoring as your working capital, because there is an existing working capital already. But what is the increment? What is the increment? What is the increment? So the difference between 1.58 and 1.658 will give you what? That is 1.58 minus 1.658 will give you a negative value. A negative value of what? Is an outflow of 0.079, since I'm using points. As at year 2, what will happen? As at year 2, what will be the result here? As at year 2, this working capital here, it will be what? 1 point what?
1.74 minus 1.659.
The result will be what?
That's 0.081.
0.081. And as at year 3, it will be what?
That will be 1.828 minus 1.74.
1.74. And we're going to have
That's 0.088.
0.088. As at the fourth year, what will happen? As at the fourth year,
I think we are going to bring that figure 1 point, the last figure of it. Oh,
as at the fourth year, it is expected that all the accumulated what? Working
all the
capital
accumulated working capital will be released.
will be released. So now, if that will be released, what will happen? That release is an inflow, right? Because there will be no need to tie up your working capital in anything again, because the project is coming to an end. The project is coming. So we are releasing all these values back into the business. There's a release of all the whole values back into the business because the business is coming to an end. So there's no need to set up working capital again for day-to-day operation. So we release it back and it will come back as what? As an inflow, as at the fourth year. Instead of tying down your money, your cash in inventory, in this, in that, in the bank, you bring them back as an inflow. So in bringing them back, what will be the value there as at the fourth year?
That's 1.828.
1.828. I'm not putting it in brackets because it's an inflow as at that point. It's an inflow as at that point. So the statement that it is anticipated that working capital of 20% of sales revenue will be needed at the start of each year. At the start of each year. The value here, this value here, is at the end of year 1. For you to get the value as at the start of year 1, this value will have to come here. So this value you are seeing here as at year 2 is at the end of what? Of year 2. That is why we are having it here. It's at the end of year 2. So, but what will be the value as at the beginning of year 2? Is the difference between these and this. We have this. The value here you are seeing is as at the end of year 3. The difference between these and this will give you what? Will give you this. The value here is at what? Is at the end of year 3. The value here is at what? At the end of year 4. So as at the end of year 4, you release it back into the business because as at the end, the business will terminate and there will be no need for working capital. Hence, it's coming as an inflow. It's coming as an inflow. That is the interpretation of that statement, of these statements that we are seeing here. these statements that we're seeing. I don't know if anybody has another perspective that you want to share with us. Yes. Let me see those that are still on the line.
Hello, sir.
All right, I'm with you, sir.
All right, sir. Thank you so much. My question is basically on this thing. Uh, Tax in arrears. I know that tax in arrears means that the tax of year one should be paid in year two, and the
Yes.
one of year two.
Okay, we can't hear you again, sir. Hello, we can't hear you again.
Hello, sir. Can you hear me?
Yes, we can hear you now.
Ah,
I can hear you now. You can speak. We can hear you.
Just let the meeting too.
It's trying to come back again. Yes, yes. To portray what he's trying to say, when in the question, I think there's a place the question mentioned it coming to the issue of tax. Tax. The question made it clear somewhere. Yes, the issue of tax. That Kings Limited pays tax at the rate of 20% on profit in the year in which tax liability occurs. Now, in a general parlance, I think when somebody was solving, the person was all right. You can speak on, sir. We can hear you, sir.
all right. Thank you, sir. So I was talking about in a case of this thing tax, where tax is paid in arrears,
Yes.
and now if tax is paid in arrears, what is the implication of it to tax save on capital allowance?
Yes, it will also the tax savings will not come in that year likewise. It will go alongside with the year in which there is the tax is being paid in arrears. Yes. So I think once the tax is paid in arrears, tax savings will also follow that procedure. You understand? They will move line hand in hand. They will move hand in hand. If tax of year one is paid in year two, the tax savings will also be in that year two. So this on I don't know if that is clear before I move on.
Yes, sir. Yes, sir. But there is a question. The tax was paid in arrears, but the this thing tax save was not the same pattern, so I was confused. Is in ICANN study pack? I saw it there.
Okay. So the tax savings is expected to move hand in hand with the period in which the tax areas is occurs or is being paid.
I forwarded it to the group. I just forwarded it now to the group so that you
Okay.
can just. I don't know why.
I've also
All right.
solved it. I encountered the same challenges.
You said?
I've also solved that question.
Okay. Let me
So the
see.
capital allowance was charged on year zero instead of
Exactly.
Okay.
yeah.
Okay, let me see then. That's cash inflows, cash savings, initial outlay, net cash flow, discounted present value, NPV, costs, annual allowance claim, Balance is this. Yeah, is the question, have you forwarded the question to, okay, example, a capital
Yes.
allowance aimed at 25% by reducing balance method, and the first tax benefit will occur 1 year after the date of acquisition. It is expected to have a scrap value of what, of 100,000 naira at end of year 4. The post-tax cost of capital is 9%. Tax on profit is 30% and paid 1 year in arrears. Calculate the NPV. Okay. So the description, cash inflows, we have tax on cash inflows, tax savings, initial. I'll look at it and get back. I won't keep.
All right.
I'll look at that. So
All
based
right.
on this,
Yes.
this.
Okay.
All right. Speak on, please.
Okay. My second question is also on this thing MPV. Another thing is this word they call tax save on capital allowance. Now I don't know. Me, I was thinking that before we charge tax on our profit, let's say we are giving revenue and cost, then I know that what they normally do is that they deduct uh, this thing, they deduct the cost from the revenue to arrive at the profit. Then I apply tax rates. Tax is usually the next thing that comes. So I don't know. I was thinking that this tax save on capital allowance should have come before the tax. The difference here should have come because I think we are going to use our tax save. I don't know to is it to reduce because as the name implies, tax save on capital allowance. So the thing is usually confuse me if the thing should come before tax or after tax.
The issue is the tax savings. The tax savings. Once you are solving now, like this one we are solving now, once you get your tax elements on your profits, you understand the tax savings
Yes.
is actually reducing your tax liability, but it's an inflow. I don't know if you get that. It's an inflow. You know, you are deducting your tax, right, from your profits. But the issue of
Okay.
tax savings now, you are adding it back. You are adding it back. So your tax rate will be on your profits. Will be on your profits. So after determining that tax value on your profits, you know, you are lessening the tax value from your profits. So once you do that, your tax savings is an addition, is an inflow, is an inflow. So your question is whether it will come after, before deducting tax, right? Or after deducting tax.
Yes. Sir.
The point is
Yes.
this:
Sir.
tax rate is on what in your computation?
On profit.
On profit, fine. So that one is clearly defined. Once you determine your tax rate on profit, then your tax savings is an inflow, which will be an addition, showing that that tax you've deducted, the benefits of that organization investing in capital, in capital, in which the government encourage that once you invest in social capital, in social assets, you enjoy tax savings. So the benefits of you enjoy when you invest in such assets known as tax savings is an inflow to the organization. So having determined your tax rate on your profit, your tax savings will come in as an inflow. So it will not come before deducting tax, or you understand? So
Yes. Yes.
your tax
Thank you,
is
sir.
clearly on profit. And once you determine that, your tax savings can come as an inflow because MPV is looking at cash inflow and outflow. And outflow.
All right, sir. Thank you, sir.
So that Kings Limited pays tax rates, pays tax at a rate of 20% in the year in which liability occurs, and any tax losses on the investments can be carried forward and written off against future profits from the investment. So this means that tax is paid in the same year profit is earned, meaning no lag exists between earning profits and paying tax. So when calculating annual net cash flows, you must deduct tax from the year's operating profit in that same year. Yes, in that same year's and from that same year's cash flow. So it means that this is not a case of tax paid in arrears. As the liability occurs, as you make profits, you charge your tax without any delay. So the cost of capital for Kings Limited has been estimated at 12%. Now, this issue of cost of capital, what do you need it for in the question?
To
What do you
discount
need?
the cash flow.
Discount factor.
Is a discount factor. The discount factor. So based on all these explanation, there is need for us to prepare a table showing our inflow and our outflow from all what we've done, from all we've discussed. So let's see. It's getting late. So let's see.
Hello, sir. I have a question.
All right. What is your question, ma'am?
Okay, what if they are silent when to pay tax and to claim tax relief? What should we do?
Okay, where the question is silence on the issue of tax. Yes, I know the clear point is that tax is always in arrears, right? In arrears. That is the principle that the profit we made this year, the tax will be levied next year. So where the question is silent and there is nothing about if tax is paid as at the time the liability occurs, you treat based on the normal rule of tax. That is, you apportion it in arrears. Yes, in arrears. That is where it is silent. But where it is not silent and it is clearly defined in this way, you work according to the direction of the question. Yes.
All right. Thank
Hope
you.
that is fine.
Yes, sir.
Are you writing tax?
No.
Who is writing tax here? Nobody. So I'll just show a format. I need to calculation of MPV. I know some of us have the solution. I'll just, if you don't have it, I'll forward it to the group. We have the years. We have year 0, year 1, year 2, year 3, and year 4. Because the question made it clear that the project will last for a period of 4 years. 4 years. So based on this now, in the question, as you read, you discover you have issue of sales revenue, operating costs. That is pointing you to the point, the fact that you need to determine what you need to determine, look for the difference between your revenue and your operating cost. You need to determine your revenue and your operating cost. So Your revenue is what? Is an inflow, right?
Yes.
Your revenue is an inflow. In year zero, there was no any results in relation to revenue. Our revenue in year one, based on our workings, is what?
7.9.
7.9. In year two is what?
8.295.
8.295. And in year three is what?
In 3 is 0.7.
8.7. And year four is what?
9.145.
9.145. So looking at the question, that operating costs are expected to be. So the fact that you have revenue and you have operating costs, there is a point there. There is a pointer there that you need to determine what? You need to determine what?
Contribution.
You need to determine contribution of profits. So the operating costs is what for each of the years? Operating costs for year one is what?
5.2.
5.2.
And for year two is what? 5.671. And for year three is what?
6.046.
6.056. And for year four is what?
6.512.
6.512. So the difference between these two values will give us what?
2.7.
2.7.
2.7. 2.6 what here?
2.624. 624.
2.24. And this will give us 8.7 minus 6.056.
2.644.
2.644. And for this to give us what? 9.145 minus
2.633.
2.633.
633. So what are we going to call this now? This is revenue, operating
Profit.
cost.
That's our net profit.
Or we can say, yeah, or operating profit, which is same as net profit. So based on this now, you have your tax, right?
Yes.
Your tax will be based on what? And your profits.
Based on profit.
The tax rate is what? 20%.
20%.
So tax element, tax on this value 2.7. You have what?
0.54.
0.54.
And for year two, you have what?
524,800.
Is it 0 point?
0.5248.
0.5248.
And for this,
0.5288.
and for this,
0.5266.
You know, it will be in brackets because it's an outflow. So based on this, what is next?
Tax saving.
Tax saving.
Tax savings. The tax savings is an outflow, right?
No.
Inflow.
Fine. I'm just trying to test what is happening. So low. So we have it tax savings. Tax savings. For year one is what?
0.600.
600. For year two, we have it as what?
0.450.
0.450. And for this,
0.337.
and for this,
338.
the tax savings. Hope this is correct for this year four.
Yes, sir.
Yes, about this year 3, I'm thinking it should be 338.
Somebody else should confirm, please. Is it 338?
That's because the tax service we have is 337,500.
Yeah, that's fine. Yeah. So, what next do you think will come on this performer?
Working capital.
Working capital is an outflow, right?
Yes, sir.
Starting from year one, year zero,
Yes, sir.
Yes.
we have it as what?
1.58.
1.58. Then in year two, year one, this 0.7 is our workings. Let me pick it there. Right. 0.079, 0.081, 0.081, and this is what? 0.088. 0.088, and this is what? 1.829. 1.829. So these are all outflows. These are outflows. These are outflows. But the fourth is an inflow. So at this point, we have the issue of our investment. We invested 12 million, and that 12 million was invested as at which year before operations?
Zero.
As at year zero is an outflow. Is an outflow. As at the fourth year, there was a scrap value, right?
Yes.
Which would be an inflow.
4.5.
Wow, this one I'm writing it in the full like this. So this one will be what? Going by what we have over time. 12 million divided by 1 million. That is 12. Just 12. While this is 4.5
4.500.
divided by 1 million. That is 4.5. It's an inflow. Then what will happen as at this point now?
We get our net cash
flow.
flow.
Net cash flow. We get our net cash flow. Net cash flow. So the net cash flow as at this year zero will be what?
13.5.
13.58. As at this point will be what? From 2.7, we do the plus and minus. We're going to have what here?
So should that be negative? This 13.5 is
Yeah, it's negative.
2.681.
2.081.
2.681.
2.681.
Yeah.
Then for year 2, the net cash flow will be what? Zero point 5248.
2.4682.
2.4682. Then for year 3.
For year 3, 2.365.
And for year 4.
4.0464.
For year 4.
Yeah, check it.
2.633 and 0.5266 and 0.112 is 1.838 plus 0.5 will be 8.5 464. 5464 dash 1. So what next at this point?
Distance.
Yes.
Our discounted factor.
Yes, discounted factor. At what rate?
12%.
At 12%. So as at year 0, it will be 1. As at year 1, it will be what?
0.893.
0.893.
As at year 2, it will be what?
0.797.
0.797.
As at year 3,
0.712.
0.712.
and as at year 4.
0.636.
So the present value will now be what? To multiply
13.58.
PV to be negative 13.58. And for this, year 1,
Yeah, what? For year one, we have
Point three
2.394.
nine four.
Year two,
Point
1.967.
967.
and for year three,
1.684.
and for year four,
5.436.
436. So what would be the net present value?
Two point zero nine nine.
Okay,
Negative.
Yes, negative.
2.099.
Negative point 2.099.
So what is your advice?
They should not invest in the project
In the project.
You should
because
not
the calculated NPV is negative.
yes, because the NPV is negative. So, I was looking at our workings. Some people were getting positive value. Yes. And but the point is being able to understand the question and being able to interpret. That is the major thing. What they do is they mark the steps. So please, as you go to the hall and you see question, don't put your hand in your head and say, what kind of thing is this? Read the question. Read the question. Come up with the variables in the question and see how you can put them together to make sense. Yes. Don't just see a question and write yourself up that no. It is the confidence you have that will make you to pass the exams. Yes. It is the confidence that you have. You tell yourself I'll make it. Yes. But once you see a question and you just start thinking of something else, it means you're trying to to tell yourself that wow, this is not possible. It's very much possible. Yes, but what you are doing now is what is making it possible. Giving out your time to studies and everything. Yes. So if you look at the question, I think there is a written part and theory part. All right, Mr. Samson.
So sorry, let me just use this opportunity and claim myself. Another one is that incremental working capital you just calculated. I've been reading that question. I've been finding it difficult to comprehend that question in a case where that the working capital is incremental, because I've seen some questions you solve whereby the working capital was recouped at the beginning of the year one, or the year after the year of occurrence, then written off at the last year, or clearing up for the last year. But this one, I've been checking it since. I don't really comprehend. So, like, how do we determine if the working capital is incremental and if we should
Based on
write
if
it
you
off?
look at the question, what is it? Why do you need working capital? Based on sales. Based on sales. Looking at the sales figure, is the sales figure incremental? The sales figure, is it incremental in
Yeah.
nature?
Yes, sir. Yes, sir.
So the addition to the sales calls up for more working capital. So that is why you see you are looking for the difference between the incremental. It's not the whole value of sales that you are placing your your working capital on. But what is the increment, the difference between the beginning and the end, the difference between the beginning and the end. So, and the difference is based on the increase, the addition on sales. The sales in year one, if it is 50,000, what is the sales in year two? What is the increment? If the sales in year two is now 60,000, what is that increase? Yes. If the sales in year three is now 70,000, what is that increase from year two to year three? And that is what you the basis of the incremental working capital. The basis of the incremental working capital, because the working capital is used to finance the day-to-day working operation of the business. That is your inventory, your cash in hand, your bank, and every other thing that revolves around the working capital cycle. So the more sales you have, the more working capital that you have, that you need. And the question put it clearly that it is anticipated that the working capital of 20% of sales revenue will be needed at the start of each year. And your sales revenue is increasing. At what rate? At what rate? From the question, at 5% per year, from year two to four. So if your working capital is based on sales revenue, it means it is hinged on the fact that as sales revenue increased by 5%, working capital will also increase, And that is why you've seen the solution this way.
All right, sir. Thank you, sir. Uh, Also, now because the one that I solved before you shared the solution is that I did incremental this thing, like working for capital for each year based on the 20%, but I did not check the difference of year zero and year one as you did now, and year one and year two, and year two and year three. I did not check those things. I just did 20% of the incremental revenue for each year.
Yes.
And coming to this, Nana come and say that it was not solved the same. So that's the way I was finding it challenging. I said, okay, let me ask because I
All right. Okay. It's fine. So the the question also asks us to talk about assumptions that weaken the reliability of the appraisal method adopted. And those assumptions are the disadvantages of NPV. The disadvantages of NPV. That is, how well is it possible for you to rely on these results? So, based on your understanding, what do you think are the disadvantages in which we've mentioned as we using this class, as we're introducing this class? So, those drawbacks associated with NPV, are issues that we have to consider trying to answer that question, trying to answer that question that relates to the part B of the question. So I didn't send that part. You can do well to download the pilot question. I will forward the pilot question to the platform. Or if you have it, you can likewise forward it to the platform so that everybody can have access to it. Some will have access to it, but they will not open it. So that is one thing. So, and one thing we must know At this point of this exam, you'll be seeing many materials flying up and down. Don't get distracted. Yes, you'll be seeing so many materials. Know what works for you and abide by it, and you definitely experience success. Yes, your study pack, don't play with it. That I can study pack. I know some people have not opened it. It's very important. The pilot question, you go through them. Since this is the first time they're coming up with FM, I know some people are going to the extra miles of using SFM. It's fine, good, yes. But what works for your friend might not work for you. At least there is a study pack. There's a study pack for you for FM. Yes, you can make use of it. If you think you are hungry for SFM, fine, that is good. But at least try and be good on your study pack first before you jump to SFM. Yes. So I know the examiners will not just come and go and bring a question for SFM and try to, yes, they know what is within your scope of syllabus. But the beauty is everything you've learned here is also in SFM. Every topic in FM is also in SFM. But I know the question will not be that as rigid as you have it in SFM. Yes, but the thing is, we must guide ourselves well so that we experience success. So for these other parts, you can read it. I'll forward the solution to the platform. You can read the stories there. So I'll send more questions, maybe on cost of capital, which is another very key point you must be very grounded in so that we'll come up to solve it. So for these nights, I think we need to go now. Try it.
Okay, yes, sir. Thank you. But before you go, sir, can you hear me?
Yes.